We know that a partnership is a flow-through entity, but unfortunately, figuring out income taxes is not as simple as just adding it up and dividing by the number of partners. The reason this is so is because certain items of income have special limitations. So what we need to do is we need to divide the taxable income up into our ordinary income items and our separately stated items. The ordinary income items are items that have no separate limitations, exclusions, or phase outs. And then the separately stated items are going to retain their character from the partnership level, but pass to the partner as separately stated items because they have separate phase outs or limitations. So the items that are separately stated, I have listed on the right of your screen right now. Net short-term and long-term capital gains and losses, Section 1231 gains and losses, unrecaptured 1250 gains, Section 179 expenses, charitable contributions, dividend and interest income, taxes paid or accrued to a foreign country or U.S. possession, tax-exempt or partially tax-exempt interest, investment income and expenses, any items subject to special allocations, and any other items specified by the IRS. So again, all these items listed require some sort of limitation or phase out. Take charitable contributions, for example. Charitable contributions are going to be limited by the amount of adjusted gross income that the taxpayer has. And so that is a taxpayer specific thing, not a partnership level thing. That's why it has to be separately stated. The ordinary income is going to include all taxable items of income, gain, loss, or deduction that are not separately stated items. It's going to be all added up, combined to form partnership ordinary income or loss. These items are always ordinary income or expenses not subject to capital limitations. This is going to include Section 1245 depreciation recapture. That's going to be included in ordinary income. This ordinary income or loss is then allocated to each partner on Schedules K and K1, and then it's going to be reported on the partner's individual tax return. There's also special deductions. The first one is the qualified business income deduction. This is a new thing for the Tax Cuts and Jobs Act this year, and it's a kind of complicated thing, and the IRS has been slow to release regulations to explain it and guidance, so this first filing season will be interesting. But it's defined, or it allows a deduction based on the qualified business income from a flow-through entity. So I can get a qualified business income deduction because my business is an S corp, partnership, sole proprietorship. This deduction is going to be the lesser of the combined qualified business income of the taxpayer, or 20% of the excess of taxable income without regard to the QBI deduction over any net capital gain. Qualified business income is the net amount items of income, gain, deduction, and loss effectively connected to a U.S. trade or business plus 20% of qualified REIT, which REIT is real estate investment trust, dividends, and 20% of publicly traded partnership income. If we have a service business, so if I'm practicing law or accounting, I can use this deduction, but I can only use it if my taxable income is less than $157,500 if I'm a single filer, or double that, $315, if I'm a married filing jointly filer. Also, there's a further limit on the QBI deduction if my taxable income exceeds these thresholds mentioned above. And so this last further limit applies to all businesses, not just service businesses. So if I am a business and my taxable income is greater than $157,500 or $315, if I'm a married filing jointly filer, I have a further limit on my deduction, my QBI deduction. It's going to be the lesser of 20% of QBI or the greater of half the W-2 wages allocable to the taxpayer, so me, by the business, or 25% of allocable W-2 wages plus 2.5% of the allocable share of unadjusted basis of qualified property immediately after it has been acquired. Okay, so you don't have to memorize these last crazy limitations, but I do want you to be familiar with the QBI deduction. It was put in place to try to approximate the tax results of a partnership and the tax results of a corporation, because remember, the corporation got the reduction in tax rate because of the Tax Cuts and Jobs Act. So this was also put in place to try to kind of give the flow-through business entities a tax break as well. There's also a net business interest limitation. So net business interest deductibility is going to be limited to the sum of the following if the partnership does not meet the 25 million gross receipts test. So this is for larger partnerships. If I have a larger partnership, my net business interest deduction will be limited as follows. So it's limited to the business interest income plus 30% of adjusted taxable income plus floor plan financing interest for vehicles. The adjusted taxable income is defined as taxable income without regard to income, gain, deduction, or loss, not allocable to a trade or business interest or business interest income, any net operating loss, carryover deduction, the QBI deduction, the deduction for depreciation, amortization, or depletion, and any other adjustments provided by the Treasury. If we have a limitation here, a limitation of deduction of interest, that limitation is allocated to the partners and the partners can carry it forward. So it doesn't stay at the partnership level. The whole allocation is allocated to the partners and the partners can carry it forward and use it when it's no longer limited. Here we have Mark and Pamela, who are equal partners in MP partnership. The partnership, Mark and Pamela, are calendar year taxpayers. The partnership incurred the following items in the current year. In Part A, we want to compute the partnership's ordinary income and separately stated items. So remember that the ordinary income is things that don't have special limits or restrictions placed on each individual partner. And the rest are separately stated items. So looking through here, sales, cost of goods sold, section 1245 gain, depreciation because there's no 179 or bonus, the guaranteed payment, the business interest, and the meals are going to be ordinary income items. So these items can be computed on a group basis because there are no special limits applicable to the partners. The other things, the tax-exempt interest, the 1231 gain, the capital asset transactions, tax-exempt bonds, the charitable contributions, all of these things are going to be separately stated items. So here on this slide, you can see these are the ordinary income items. So we computed them on a total partnership basis. We did just the way we normally compute taxes. We did sales minus cost of goods sold to get gross profit. We added in the 1245 gain because that's always going to be ordinary gain because it's section 1245. And then we subtracted ordinary expenses that have no limitations. Depreciation, guaranteed payment, business interest, and business meals. You see that 50% limitation applicable to meals. The business interest isn't limited because we do not fail the 25 million gross receipts test. This is a smaller partnership. So the partnership ordinary income in total is $173,000. It's allocated half to Mark and half to Pamela. They're equal partners. All right, so now let's look at the separately stated items. Okay, so you can see we just list out the separately stated items and we allocate them individually to each partner. So when the partner gets that item on their tax return, they can apply their own individual limits to that particular item of income, gain, loss, deduction, whatever. So we have dividend income. Remember, dividend income gets a preferential tax rate, and it gets a preferential tax rate based on my tax rate. So it could be different for Mark and Pamela depending on the rest of their tax situation. We have tax-exempt interest, 1231 gain, long-term capital gain, short-term capital loss, investment interest expense, charitable contributions, non-deductible business meals, non-deductible interest on the loan for the tax-exempt interest. So all of these things are going to be separately stated and they're going to be reported to Mark and Pamela on their K1. Just like the ordinary income is also going to be reported on the K1 to Mark and Pamela. Part B, show Mark and Pamela's share of the items in Part A. Oh, well, we just did this. So which items would qualify as business income for the QBI deduction? Oops. All right, and then Part C, compute Mark and Pamela's ending basis in their partnership interest, assuming their beginning balances are $150 each. Okay, so we start with 150. We adjust up for our share of income. We adjust down for our share of expense. We also make adjustments for liabilities. And we make adjustments for things that are tax exempt, so they're not part of our taxes, but they're still income or expense. And we adjust either up or down for these. So again, we start at 150. We add our ordinary income. We add our share of dividend income, our share of tax exempt interest income, our share of 1231 gain, and our share of net long-term capital gain. We subtract the reduction any distributions. So if we receive any distributions, and in here it says, down here on that last line in the prompt, it says distribution to partners is $40,000 each. So we subtract for distributions, reduction in partnership liabilities, and it tells us down here, the third from the bottom, it says partial payment on business loan. So they paid $14,000 on their business loan. So we reduce the basis for the reduction in partnership liabilities. We reduce for short-term capital loss, investment interest expense, charitable contributions, non-deductible business meals, and non-deductible interest on the loan for tax-exempt interest. So even though these items are not allowed a deduction for tax purposes, we do reduce our basis for those amounts. And from there, we get our ending basis in the partnership of $195.5 for Mark and for Pamela. Okay, now the partner reporting of income. So on the partner side, a partner pays taxes on his distributive share of partnership ordinary income or ordinary loss and the separately stated income, gain, loss, deduction, or credit items. This distributive share is normally determined by the terms of the partnership agreement, or if the partnership agreement is silent, by the partner's overall interest in the partnership as determined by taking into account all facts and circumstances. A really interesting and useful thing about a partnership is that we don't have to allocate every item 50-50 or 20-80 or whatever. So if I'm a 20% partner, I don't have to receive a fifth of every item of income. It can be allocated where I receive all of one type of income and none of another type of income. And generally, the default agreement is to do what I said, is to receive, if I'm a 20% owner, receive 20% of each item of income, deduction, loss, whatever, but it doesn't have to be that way. The partnership agreement can allocate it another way. A partnership agreement may describe a partner's distributive share by indicating the partner's profits and loss interest, or it may indicate separate profits and loss interest. If only one interest percentage is stated, it's going to be used to allocate both profits and loss, but it doesn't have to. 2 is a varying interest rule. If a partner's ownership interest changes during the partnership tax year, the income or loss allocation takes into account the varying interest. Now, I'm allowed to make these allocations as long as they have substantial economic effect. So we're going to talk about that, and we're going to talk about allocations related to contributed property. When a property is contributed to a partnership, it takes a substituted basis, so we know this, right, a transferred basis, that references the contributing partner's basis. Pre-contribution gains or losses are allocated to the contributing partner for any property contributed to the partnership. Income and deductions reported in connection with the contributed property must be allocated to reflect the difference between the fair market value and the adjusted basis on the date of contribution. So if I if I contribute an asset to the partnership in return for a partnership interest, we know Section 721 says that's not taxable. So if I contribute an asset and my basis is $8,000, on the date of contribution, the fair market value is $10,000. I have a pre-contribution built-in gain of $2,000 that I do not recognize. So at that date, the partnership takes an $8,000 basis in that asset because that was my basis in the asset and I didn't recognize any gain. If 5 years later the partnership sells that asset for $12,000, it has a $4,000 gain because it took my transferred basis of $8,000, sold it for $12,000, that's a $4,000 gain. I am allocated my pre-contribution gain of $2,000. The other $2,000 of gain is going to be allocated as stated in the partnership agreement. Okay, and then under the substantial economic effect rule, special allocations related to other than contributed property must meet certain criteria that are designed to ensure that the allocations affect the partner's economic consequences and not just the tax consequences. An allocation has economic effect if it meets these rules. So what this is talking about is when I allocate all of a certain type of income to me and a different type of income to the other partner. And that's going to be allowed, like I said, but it has to have substantial economic effect. So first, it has an economic effect, and that means the allocation results in the appropriate increase or decrease in the partner's capital account. The proceeds of any liquidation occurring at any time in the partnership's life cycle are distributed in accordance with positive capital account balances, and the partners must make up negative balances in their capital accounts upon the liquidation of the partnership, and these contributions are used to pay partnership debts or are allocated to the partners having positive capital account balances. For it to be substantial, there has to be a reasonable possibility that the allocation will substantially affect the dollar amounts to be received by partners independent of tax consequences. Items that shift tax benefits will fail this test. So a net change in the partner's capital accounts will be the same for a normal allocation and the special allocation, and the total tax liability of the partners will be less with the special allocation than with the normal allocation. All right, so here we have Patty. Last year, she contributed land with a $4,000 basis and a $10,000 fair market value in exchange for a 40% profits, loss, and capital interest in the PD partnership. So already we know when we look at this asset, this land, it has a $6,000 built-in gain, right? She doesn't recognize any gain, but it has a $4,000 basis and a $10,000 fair market value, meaning that the partnership will take a $4,000 basis in that land. Dave contributed land with an $8,000 basis and a $15,000 fair market value for the remaining 60% interest in the partnership. This also has a pre-contribution gain, you see. It has a $7,000 pre-contribution gain that isn't recognized because the partnership takes the basis in the land of $8,000. During the current year, PD partnership reported $8,000 of ordinary income and sold the land that Patty contributed for $14,000, thereby producing a taxable long-term capital gain of $10,000. What income or gain must Patty and Dave report from the PD partnership in the current year? Okay, so we have two items of income to consider. We have ordinary income, and we know that's going to be allocated as stated in the partnership agreement. Here we see that it's a 40% allocation to Patty and a 60% allocation to Dave. And then we have a long-term capital gain of $10,000. We know ordinarily, pursuant to their agreement, that would be distributed 40% to Patty and 60% to Dave as well. But we have a pre-contribution gain of $6,000 for that land. And we know that that pre-contribution gain must be allocated to the partner who contributed the asset. Here it's Patty. So we know that to Patty we allocate 40% of the ordinary income, so $3,200 there. We also know that to Patty we allocate $6,000 of that $10,000 gain. And then the remainder of that, the $4,000, 40% of that will be allocated to Patty. All right, so the total income or gain allocated to Patty is $10,800. For Dave, we're going to allocate 60% of the ordinary income, or $4,800, and then we're going to allocate 60% of the post-contribution gain, so the $4,000 from the sale of the land that occurred post-contribution, 60% of that will be allocated to Dave.